Hey, what's up, you guys? Welcome back. So, I hope you all are enjoying this small rally that we've been having in the stock market recently. And I know we were going to say, you're going to be like, small rally? Come on, the Nasdaq's up 20%. You call that a small rally? Well, what I have to say to that is, I do think that this is a small rally compared to what's possible and what might be to come if I am right about things, right? So, let me explain further. In case you missed what's been going on, let me catch you up first though. So this rally started in mid-January on the hopes that the Fed was going to go easier with the rate hikes compared to 2022. And on February 1st, the Fed did exactly that. They slowed down the pace of rate hikes to a 25 basis point increase this time. Now, that part was actually expected. However, what wasn't expected was how dovish Jay Powell sounded on the speech. By the way, if you don't know what dovish means favoring looser monetary policy. So think of a dove that's docile and peaceful and non-aggressive versus the opposite of that would be hawkish, which is favoring more aggressive monetary policy. So think of a hawk that's much more intimidating. Hawkish means favoring bigger rate hikes and more aggressiveness. So Jay Powell was somewhat neutral, leaning dovish, meaning that he's not aggressive. He's actually trying to say, oh, let's look at the data, let's not go too hard and crush the economy and stuff. So this is different than what he was saying back in 2022, which was, we're going to go hard on inflation and we're not going to let up, stuff like that. So he was a lot more dovish this meeting, which led to the markets roaring afterwards. But I'm sure the question on everyone's mind is this rally going to last? And I can't tell you the answer to that question because I don't have a crystal ball and I can't predict the future. Sorry, that was anticlimactic, but yeah, I can't predict the future. But the way I think about it is, long term, the Fed will have to stop the rate hikes at some point. And for rallying, just because the pace of the rate hikes has slowed down, imagine what it would be like if the Fed just paused interest rate hikes altogether. And that's not out of the question that the Fed will pause rate hikes sometime within the next 3 to 4 months because the Bank of Canada, for example, has already indicated that they're willing to pause rate hikes, and other central banks in other countries around the world have already signaled similar things. Right now, for the US Fed, the markets are pricing in 2 more 25 basis point rate hikes, once in March and once in May. And I think they're going to be done after that. They might not even do the May one, but I think they will do the March one for sure. This is because if inflation plummets, there'll be no need to do excessive rate hikes, right? So it all depends on inflation. But of course, unemployment data is also important. So the latest job report that we got was a huge surprise to the upside in terms of the amount of jobs that we added. Which in turn led to the unemployment rate actually falling to 3.4%. So it was expected to go up, but it actually fell to 3.4%, which is the lowest since 1969. So usually this is the opposite of what you would expect if we were going into a recession, if we're in a recession already even. So this is the exact opposite of that, right? The unemployment rate is actually going down. And what I have to say to that is, although the recession risk has plummeted, we might still hit a recession just because the unemployment data, it lags by a few months. And within the past few months, I've seen a lot of layoffs still from big tech giants, which I already talked about in my previous video, but also layoffs from other companies like IBM, Dell, FedEx, just to name a few. There's more. But yeah, I think we will see unemployment go up still. It just hasn't been reflected yet. And the bad news, of course, with unemployment going down is that it actually is kind of bad news as well. Like, you think that that would be good news if we're avoiding a recession. But I've seen a lot of debate and arguments online where people are like, okay, if the unemployment rate doesn't go up, then the Fed will keep hiking. And that's not necessarily true, in my opinion. It could be true, but it's not necessarily true. Remember that at the end of the day, the Fed doesn't want the unemployment rate to go up actually, because it's part of their mandate to keep unemployment low. They only quote unquote want unemployment to go up for the sake of tackling inflation. But if inflation comes down naturally without unemployment going up, then you know what that's called? That's called a soft landing. So I think 2022 was so bad that people gave up the idea of a soft landing and they were just like, it's definitely not possible. The Fed's lying to us and they're just pumping us with hopium. It's either runaway inflation or the Fed hikes us to a recession. But people have forgotten that the best case scenario for the Fed is a soft landing, which is, by the way, if you don't know what a soft landing means, it means bringing down inflation without triggering a recession. So if they could have both, like have your cake and eat it too, right? If they could bring down inflation but not have a recession. And admittedly, I would still say that that's not the most likely scenario. However, I do think that the Fed could be seeing that option on the table again if if everything starts to trend in the correct direction, which inflation is plummeting, right? It's going down, and arguably it's going down faster than expected. So we've seen some good signs, and unemployment is still relatively low. But yeah, it all depends on inflation. If inflation falls fast enough, we could potentially avoid a recession, and the Fed could pause interest rate hikes and maybe even do a few small cuts at the end of the year or closer to the end of the year. Who knows, right? But on the topic of inflation, though, let me share a comment that I got on my previous video where I talked about inflation and rate hikes and all this stuff. Now I'm going to read you this comment and we'll talk about what I think of it after I read the comment. And I do have a lot to say, okay? But let me read you it first. So the comment says, LMAO, you go to a website to see where inflation is at. How about you go buy some eggs and get some gas? Because here in California, inflation hasn't left. It's only gotten worse. Get your facts straight. If the Fed doesn't continue hiking, then your children's future will be even more of a catastrophe. Now, I welcome disagreement on my channel, so don't be afraid to call me out and challenge me if you think that I said something wrong or if you just disagree with me in general. I want to make that very clear. I do welcome, disagreement, and I do welcome alternate thoughts. However, this is just a bad take. These are just bad takes after bad takes. This is more than one bad take, and I'll tell you why. So the first issue that this person had with me is that I went to some website to check where inflation is at, and by some website they mean trueflation.com, which I shared a screenshot of it back in my last video. So if you missed my last video, here's what trueflation.com looks like right now. And as you can see, it measures inflation across a slew of different categories over time. And this data is for the US, but they also support data for the UK. And I've been asking them to add Canada, but they haven't gotten around to it yet. So essentially, this person is telling me that I shouldn't trust actual data that is being carefully measured and aggregated across the entire country. So, instead, what should I do? Well, instead, I should go buy some eggs in California and gas in California and see what inflation is, because inflation hasn't left. So basically, instead of looking at charts and actual data, the price of eggs and gas at a particular unspecified location in California should be used as a gauge as to whether Fed should continue to hike interest rates. Okay. I'm not sure I'm following the logic, but let's move on. To be fair, I do understand that there is an egg shortage right now in the United States, so egg prices have gone up a lot. But first of all, there are still places you can buy eggs in the United States for relatively normal prices. And gas prices in California tends to be higher than normal than the rest of the country, just in general, just in normal times as well. And last of all, California is not representative of the entire country, right? I think most people will agree with me when I say that California has some of the highest costs of living in the entire United States. And also, the egg shortage is mostly caused by a supply chain shortage. So the effectiveness of using rate hikes, and I talked about this before in my previous videos as well, the effectiveness of using rate hikes to tackle supply problems is very limited. The Fed cannot make eggs appear out of thin air by changing the interest rate, which is a sentence that I never thought I would utter before 2023. I don't think anyone has ever said that sentence before 2023. But yeah, the Fed raising interest rates doesn't make goods and services appear out of thin air. It just gets more people fired, and it makes doing business harder. Imagine if you're trying to get into the egg business right now because, look at the profits, but you need a $50,000 loan to get started. You might not qualify for that loan now because the interest rate went up. And even if you could qualify, you might not be able to afford the interest on the loan. So if anything, it makes the problem worse because it makes doing business harder. So if the economy gets trashed from rate hikes, then the price of eggs, even if it comes down, you won't be able to buy any because it'd be permanently sold out because there's no supply, right? So you need to find a way to increase the supply, and rate hikes are not the way to go. And that's what I keep saying, right? You can't just always rely on rate hikes to tackle demand to fix the supply problem. And that's what the Fed is trying to do. And it just doesn't work, right? It might work in select scenarios in the short term, but long term, it just doesn't work. And there are other inflation measures other than eggs, right? I know eggs are a staple of the American diet, and I know how nutritious they are, and I eat a lot of them, and they're very important to our diet. However, there are some other measures of inflation, right? So this YouTube commenter is taking an extreme example of one thing that has inflated the most, i.e. eggs, and using it to say that the Fed needs to rate hike more. Well, that's like me saying that Brussels sprouts are half price compared to what they were a month ago. I don't know if they are actually, but let's say if that is the case, then because Brussels sprouts are 50% off compared to a month ago, then the Fed should cut rates and print money again. Well, like, what's the difference in logic with that one, right? That's a completely stupid argument, and it just doesn't make sense. And I really want y'all to stop making mistakes like this, right? And what I mean by that is I want y'all to stop doing proofs by example or proof by anecdote. Don't just take an example of something that happened to you or your family members or people around you and assume that everything is the same everywhere. You gotta look at the actual trends and the actual data. And the macro trends and the data, what they're telling me is that inflation is plummeting and further rate hikes are killing our economy and making it more difficult for everyday people to recover from the massive disruption that COVID brought to us within the past 2 years. And to finish addressing this comment, this person claims that if the Fed stops hiking interest rates, it will be a catastrophe for the future of our children. And this is just completely misguided. And I'll tell you what will kill our children's futures. An article from a few days ago says that the US credit card debt jumped 18.5% per year to $930 billion, which is an all-time high. And whenever you hear the word debt, that's tied to interest rates. So the more the Fed hikes, the harder it is to pay debt. And Ford has this whole continuously running timeline of layoffs on their website. The latest news is that Dell is laying off 6,500 workers. And the interest rate on a 30-year mortgage has doubled since a year ago. So tell me how beneficial it is for our children's futures when they grow up in a household where their parents lose their jobs, get buried in credit card debt, and is on the edge of having their house foreclosed on them or all of it at once. A lot of people are in that situation now, right? And a lot of you who are new to the channel might just be like, you just want the Fed to stop hiking interest rates so that your stocks can go up. And it's like, no, okay? So I want the Fed to stop hiking interest rates so that we can avert the most disastrous recession that we'll see in at least 3 decades. And make no mistake, if the Fed continues to be aggressive like this, they can and will push us into a recession. And if inflation was just skyrocketing, then they have no choice, right? Then I would understand, like, it's either a recession or a hyperinflation. And if I had to choose between the two, then I would choose recession, right? But we're not in a hyperinflationary scenario. So I don't see why the Fed needs to just completely kill us with rate hikes. And I think a lot of people are just misunderstanding the gravity of the situation. A lot of people are going to the grocery store and they're complaining that the price of eggs are double what they used to be and be like, hey, the Fed needs to do something about this or the government needs to do something about this. But I don't think you're actually prepared for what's to come. You see all these layoffs and you don't care about these layoffs because you weren't the one being laid off, right? But nobody thinks they're going to get laid off until one day they do. All these people at Dell that just got laid off, they probably didn't really care about the Google layoffs because they're like, oh, I don't work for Google. You're not actually prepared for the recession of the decade. So be careful what you wish for, right? The consequence of these continued rate hikes has more to do with just the price of eggs. And I want you to look past the price of eggs. I just feel like if you want the Fed to rate hike more because you feel like you're paying too much for eggs, That's like complaining that your tea is cold while you're on the Titanic headed for an iceberg, right? I think it was Neil Kashkari, who's the president of the St. Louis Fed, who said sometime last year that the Fed might have to do rate hikes all of 2023 and not pause until 2024. And if that's the case, they'll end up at what, like 6.5 or 7%? And yeah, that'll push us into a deep recession for sure. And my point is that that's just so unnecessary because inflation is already coming down naturally. And yeah, like it's just, they don't need to completely kill the economy. Like, just wait, right, for the rate hikes to take effect and for the inflation to come down just by itself and for the supply chain issues to work themselves out. Like, what is wrong with that, right? Why do we have to completely make everyone lose their jobs? That's just my point, right? Unless you have some other thesis that you think that inflation is just going to reignite and become hyperinflationary. So if that's the case, let me know of a scenario where you think that will happen. But I just don't see it, right? So I wish I could end today's video on a lighter note, but that's all I got. Let me know if you agree with me or if you think everything I just said is BS, or if you think I'm insane. So I'd love to hear what you think down in the comments, and I'll end the video here. Be sure to hit the like if you enjoyed the video, and consider subscribing if you like the series. And be sure to follow me on Twitter as well, links down in the description. So with that being said, I'll see you guys in the next video. Bye-bye.